Silver is already near the edge. Gold is knocking on the door, and everyone is asking the same question. Do you sell before the pullback wipes you out, or do you buy? Because this is only the beginning. But here's what most investors don't know. While the media talks about charts and blow-off tops, the real signal is hiding in plain sight. Record deliveries, quiet arbitrage, and a paper market that may not survive what's coming next. Because if one thing breaks at those big round numbers, the next move won't be a dip. It could be a moment where people can't get silver at any price. Welcome to our channel, Market Metal. If you're watching this and you're over 50, you already understand one truth. You don't wait for the fire to start, you keep water ready. So please, do one small thing for yourself today. Hit subscribe, just like you'd lock your front door at night. Not because you're scared, but because you're wise. Now comment below, which city and country are you watching from? The psychological threshold event. When silver approaches $100 an ounce and gold moves toward $5,000, the numbers themselves become part of the story. They stop being prices and start acting like signals. In financial history, round numbers have always carried weight far beyond their mathematical value. They mark moments when disbelief turns into attention, when skepticism turns into policy, and when private positioning begins to show up in public behavior. From the outside, these milestones look like simple achievements. Commentators speak about strong charts, bullish momentum, and late cycle enthusiasm. But inside institutional finance, such levels are rarely treated as victory laps. They are treated as checkpoints. They force large actors to reassess assumptions that once felt permanent. For decades, silver under $50 and gold under $2,000 were not just prices. They were psychological ceilings. They shaped how portfolios were built, how risk models were written, and how metals were framed to clients. Precious metals were positioned as insurance, not drivers, as hedges, not centers, as something to own quietly, not something to build around. The approach toward 100 silver and 5,000 gold breaks that framing. At those levels, metals no longer sit politely in the corner of asset allocation charts. They begin to compete with core holdings. They challenge currencies. They challenge bonds. They challenge the idea that modern markets can be managed indefinitely through interest rates and liquidity. This is why these numbers matter, not because they are targets, but because they are thresholds. In past market transitions, similar thresholds appeared just before deeper structural shifts. When gold broke free from its fixed price in the early 1970s, the first surge did not end the story. It announced a new one. Investors at the time also asked whether it was time to sell. Many did. They took profits. They felt wise. But the deeper forces driving gold had not finished working. Inflation, trust erosion, and geopolitical strain had only begun to express themselves. The same pattern appeared in other asset classes across history. Major stock indices crossing symbolic levels before the dot-com peak. Oil breaking into triple digits before energy became a strategic battlefield. Housing prices crossing psychological medians before credit systems fractured. Each time, the first question from the public was whether prices had gone too far. Each time, the real question was whether the system underneath had changed. As silver and gold near these new milestones, market behavior begins to reveal a similar tension. On one side are short-term participants. They look at charts. They see steep climbs. They calculate pullbacks. They measure overbought signals. Their world is built on timing. On the other side are strategic actors. They do not speak often. They do not announce positions. They do not build exposure for quarterly results. They act because of policy, supply chains, balance sheet protection, and long-term survival. When prices approach levels that force attention from this second group, markets often change character. The conversation shifts from, is this a good trade, to what environment are we entering? At 100 silver and 5,000 gold, that shift becomes unavoidable. Silver, at those levels, stops being only a commodity. It becomes a resource issue. Its role in electronics, energy systems, and military technology forces industrial buyers to think in terms of access, not price. Gold at those levels stops being only a hedge. It becomes a monetary reference point. It enters discussions about reserves, settlement systems, and long-term purchasing power. This is why these thresholds do not behave like normal resistance zones. They behave like attention magnets. Large institutions, central entities, and industrial consumers are often constrained not by belief, but by mandate. They cannot act until price forces the conversation. Risk committees need triggers. Boards need justification. Governments need political cover. Symbolic levels provide it. Once crossed, metals stop being alternative. They become relevant. That relevance changes capital flow patterns. It brings new buyers who do not exit easily. It forces new hedging behavior. It reshapes the way financial media frames the assets. And it pressures paper-based markets that were designed for speculation, not sustained physical demand. This is why moments like these are rarely quiet. They are noisy on the surface and tense underneath. Publicly, the focus stays on price. Headlines track every dollar. Commentators debate pullbacks. Analysts argue over momentum. Privately, balance sheets are being reviewed. Procurement strategies are being rewritten. Risk models are being adjusted to include variables that were previously dismissed. In those internal rooms, the question is not whether silver will dip $5 or gold will drop 200. The question is whether the old structure still holds. This is where the true dilemma begins. If metals were simply rising because of enthusiasm, then selling into strength would make sense. Cycles end, speculation burns out, prices revert. But if metals are rising because the environment is changing, then strength is not the end. It is the beginning of repricing. Repricing is different from a rally. A rally moves within a system. Repricing happens when the system itself is being questioned. At these levels, the market is no longer asking only how high prices might go. It is starting to ask what those prices mean. Do they reflect inflation? Do they reflect currency dilution? Do they reflect supply strain? Do they reflect geopolitical fragmentation? Or do they reflect all of them at once? Each answer carries different implications, but all of them point toward structural pressure, not speculative excitement. This is why, as silver approaches 100 and gold moves toward 5,000, the buy or sell question becomes incomplete. The deeper question forms underneath it. Is this a moment to exit a trade or to recognize a transition? Because transitions are not measured in dollars. They are measured in behavior. And behavior is beginning to change. In the next stage of this analysis, attention moves away from screens and headlines and towards something markets often hide during periods of stress. Not price, but delivery. Because in commodity markets, especially in precious metals, the true story is not written by those who trade contracts. It is written by those who take possession. The hidden market. No one sees. While most investors watch price charts, another market is speaking more quietly. It does not speak through headlines. It does not move through social media. It does not care about technical patterns or daily sentiment. It speaks through delivery. In precious metals, there are two markets operating at the same time. One is visible. It is fast. It trades contracts, leverage, and opinion. The other is hidden. It is slow. It moves physical metal. For decades, these two markets behaved as if they were the same. Prices rose and fell. Contracts were rolled. Very little metal actually changed hands. The system worked because most participants never asked for delivery. They closed positions. They settled in cash. They trusted that metal existed somewhere behind the numbers. That trust is now being tested. Behind the scenes, delivery activity has been rising in ways that do not match normal speculation. Not just in scheduled months, not just in small lots, but in volumes that force attention from the people who actually run the system. In the modern metals market, asking for delivery is different from placing a trade. A trade expresses opinion. Delivery expresses need. Traders want price movement. Takers want metal. And those two groups behave very differently. When a hedge fund buys silver futures, it is usually positioning for price. When a large institution stands for delivery, it is positioning for access. It is removing material from the system. It is transferring bars from exchange vaults into private control. That act changes supply dynamics in ways charts cannot show. In recent months, delivery volumes have not behaved like noise. They have behaved like accumulation, large blocks, persistent flows, activity even in months that were never meant to see major movement. This matters because futures exchanges were never designed to operate as long-term distribution centers. They were designed to facilitate hedging and speculation. Their inventories are optimized for turnover, not sustained withdrawal. When delivery becomes continuous instead of occasional, pressure builds silently. At first, nothing appears wrong. Prices still print. Contracts still clear. Settlement still occurs. But underneath, the system begins to thin. Bars move out. Vault lists change. Eligible inventories shrink. This is where the hidden market diverges from the visible one. Visible markets respond to emotion. Hidden markets respond to constraint. And constraints create different outcomes. One of the earliest signs of constraint is not a price spike. It is hesitation. Longer settlement times, rising lease rates, unusual premiums between regions, persistent backwardation. These are not features of excited speculation. They are symptoms of material stress. When buyers are willing to pay more to secure metal now than to promise to receive it later, something fundamental is shifting. The market is no longer rewarding patience. It is rewarding possession. In normal conditions, futures cost more than spot. Storage, insurance, and time add value. When that relationship flips, it signals that immediate access is becoming more valuable than financial convenience. That is not a trader's signal. That is a supply signal. At the same time, regional price differences have begun to widen. Premiums appear where they should not exist. Arbitrage flows increase. Metal is pulled from where it is cheapest and sent where it is most needed. This movement does not happen because of excitement. It happens because some buyers are willing to pay whatever is required. This behavior reveals something important. Price is no longer clearing the market alone. Delivery is. In a price-driven market, sellers appear when prices rise. Supply meets demand. Equilibrium returns. In a delivery-driven market, sellers disappear. Supply is removed. Equilibrium is delayed. This is why delivery trends often matter more than price trends. They show whether participants are trading paper or repositioning reality. And reality is harder to reverse. When physical silver leaves exchange systems, it does not return quickly. Industrial buyers do not flip metal for profit. Sovereign entities do not trade bars on momentum. Strategic holders do not stop accumulation because of volatility. Their time horizon is measured in years, not candles. This creates a one-way pressure. Paper markets can expand instantly. Physical markets cannot. Every contract created adds theoretical supply. Every bar removed subtracts real supply. Over time, this imbalance grows. The visible market may still appear liquid. Volumes can stay high. Open interest can look healthy. But if delivery continues to drain underlying inventory, the market's foundation quietly erodes. This is how structural shifts begin, not with collapse. With subtle divergence, with charts saying one thing, and warehouses saying another, with commentators debating corrections, while logistics managers secure transport, with retail arguing about price targets, while institutions lock in tonnage. This divergence creates tension. The more physical demand asserts itself, the less relevant short-term price moves become. The system can tolerate speculation. It cannot tolerate sustained withdrawal. Eventually, something must adjust. Either prices rise enough to ration demand, or access becomes restricted. In metals history, when delivery pressure dominates, markets do not fail loudly at first. They adapt. They introduce delays. They adjust margin requirements. They expand eligible definitions. They settle in cash. These are not technical tweaks. They are stress responses. They appear when paper promises grow larger than physical comfort. This is why the delivery story matters more than any headline. It reveals who is acting with urgency. And urgency in commodities rarely comes from excitement. It comes from need. Need to secure inputs. Need to protect reserves. Need to remove dependency. Need operates in the background. And background forces are what drive long cycles. As silver and gold approach symbolic thresholds, visible markets attract attention, but hidden markets are already speaking. They are saying that something is being repositioned. Not a trade, not a narrative, but ownership. And when ownership shifts quietly, price eventually follows loudly. In the next stage of this analysis, the focus widens. Because delivery pressure does not exist in isolation, it is emerging inside a broader change in how nations, corporations, and institutions view resources themselves, not as assets, but as strategic instruments, and that distinction changes everything. The global scramble for what cannot be printed. Behind every delivery request, there is a reason, and behind the recent surge in physical demand, there is a larger movement that extends far beyond silver and gold. It is the movement away from paper confidence and toward physical control. For most of the modern financial era, wealth was measured by access to markets. Nations competed in bonds, equities, and currencies. Power flowed through liquidity, credit, and institutions. Resources were important, but they were treated as inputs, not foundations. That assumption is changing. The global environment that supported it is fracturing. Supply chains that once stretched effortlessly across continents are being shortened. Trade relationships that once prioritized efficiency are being rewritten around security. Political alliances that once stabilized markets are being replaced by competitive blocs. This is not a market cycle. It is a structural realignment. In this new environment, nations are rediscovering something older than finance. They are rediscovering material reality. You cannot stimulate copper. You cannot print lithium. You cannot extend silver. Every advanced system depends on substances that must be extracted, refined, transported, and protected. Energy grids, defense platforms, digital infrastructure, medical systems, communications networks, all of them collapse without physical inputs. Silver occupies a unique place inside this structure. It is not only a monetary metal, it is also a technological metal. It flows into solar panels, electronics, batteries, sensors, and defense components. Gold, while less industrial, remains unmatched as a neutral reserve. It carries no liability. It requires no permission. It functions outside of political agreements. Together, these metals sit at the intersection of industry and sovereignty. And intersections are where competition concentrates. As geopolitical trust weakens, strategic behavior strengthens. Governments begin to treat metals the way they once treated oil, not as commodities to be sourced cheaply, but as assets to be secured continuously. This shift changes who the marginal buyer is. It is no longer primarily the investor. It is the planner. Planners do not buy dips. They build stockpiles. They do not measure returns in quarters. They measure vulnerability in years. And vulnerability is rising. Industrial policy is returning. Resource nationalism is expanding. Export controls are spreading. Military spending is growing. Energy systems are being rebuilt. Artificial intelligence infrastructure is accelerating. Electrification is intensifying. All of these trends converge on the same bottleneck: materials. But the materials sector was not built for this world. Mining capacity did not expand during decades of financialization. Exploration budgets were cut. Ore grades declined. New projects slowed. Environmental and regulatory constraints tightened. Development timelines stretched into decades. The system optimized for returns, not resilience. Now, resilience is being demanded from a structure that was never designed to deliver it quickly. This creates a dangerous lag. Demand can rise in months. Supply responds in decades. That gap is where strategic competition forms. And it is where price loses its power to solve shortages quickly. Higher prices do not open minds. They attract attention. Attention brings capital. Capital enters permitting. Permitting enters politics. Politics enters years. This is why physical markets behave differently once strategic demand dominates. When materials are needed for national objectives, they are not released because prices rise. They are accumulated because access matters more than cost. This is the logic of stockpiling. It removes metal from circulation permanently. Every bar stored in a vault is one less bar available to a factory, an exchange, or an investor. Over time, this behavior changes market structure. It shifts metals from flow assets into reserve assets. Flow assets circulate, reserve assets accumulate. Silver and gold are moving from one category toward the other. This is what makes the current environment fundamentally different from prior metal cycles. In the past, peaks were driven by speculation. When leverage broke, prices collapsed. Metal returned to the market. The cycle reset. But strategic accumulation does not unwind easily. Stockpiles are not liquidated because momentum fades. They are held because uncertainty persists. And uncertainty is not fading. It is multiplying. Currency systems are fragmenting. Payment networks are being regionalized. Reserve composition is shifting. Nations are experimenting with settlement outside traditional frameworks. Trade corridors are being militarized. Technology is being weaponized. Energy is being politicized. All of this increases the value of neutrality. Gold offers neutrality in finance. Silver offers indispensability in function. Together, they offer something no digital asset, contract, or policy can: continuity. This is why the scramble is quiet and relentless. It does not need advertising. It does not require slogans. It only requires procurement orders. Each order expresses the same conclusion: that in a world where trust thins, control thickens. This does not mean panic. It means preparation. Preparation always looks slow from the outside, until it suddenly looks obvious. And when it becomes obvious, access narrows. This is where suspense enters the metal story, not in daily price swings, but in whether the system designed for paper convenience can continue to support physical necessity. Because when strategic accumulation overtakes speculative circulation, markets behave differently. They stop clearing smoothly, they stop responding politely, they stop obeying familiar models, they begin to reveal where stress is stored, and stress always surfaces eventually. In the final stage of this analysis, the question becomes unavoidable. If this is not simply a rally, but a strategic realignment, then the decision facing investors is no longer about timing exits. It is about choosing frameworks, trade mentality, or structural positioning. Because those two paths lead to very different outcomes, and only one of them aligns with a world that is quietly reorganizing itself around what cannot be printed, the decision that redefines risk. By the time silver approaches $100 and gold moves toward $5,000, the conversation changes whether investors want it to or not. What once looked like a speculative surge now resembles a systemic adjustment. And in systemic adjustments, the greatest risk is not volatility, it is misinterpretation. Most financial decisions are made inside familiar frames. Prices go up, prices go down, assets rotate, cycles repeat. This mental model works well when the underlying system remains intact. It allows investors to manage exposure, rebalance portfolios, and extract profit from fluctuations. But when the system itself begins to shift, familiar frames become dangerous because they encourage the wrong question. Instead of asking, what environment is forming? They ask, where's the top? Instead of asking, what is being repriced? They ask, how far did it go? These are not the same questions, and they do not lead to the same decisions. At major monetary and resource turning points, history shows a pattern. The early stage is dismissed, the middle stage is debated, the late stage is chased, and the final stage is regulated. The current moment sits between dismissal and debate. Prices are high enough to demand attention, but not yet disruptive enough to force consensus. This is where confusion thrives. Some participants are taking profits because they see familiar shapes, parabolic charts, media excitement, retail interest. They interpret strength as exhaustion. Others are increasing exposure because they see unfamiliar behavior, delivery pressure, supply strain, policy shifts, strategic stockpiling. They interpret strength as repricing. Both groups are responding rationally, but they are operating from different assumptions. One assumes the old structure remains dominant. The other assumes it is being replaced. This divergence defines the real buy or sell dilemma, not as a trade, but as a worldview. In a stable system, selling strength makes sense. Capital moves to undervalued assets. Mean reversion governs outcomes. Liquidity is abundant. Counterparty risk is low. Supply chains are elastic. In a transitioning system, strength is not excess, it is signal. Capital migrates toward protection. Scarcity replaces surplus. Liquidity fragments. Counterparty risk rises. Supply chains harden. In this environment, the question becomes less about upside and more about insulation. What does a portfolio protect against? Currency erosion? Settlement disruption? Supply interruption? Political leverage? Financial repression? Because metals address different risks than equities, bonds, or real estate. They are not growth instruments. They are continuity instruments. They do not promise income. They reduce dependence. This distinction reshapes the logic of allocation. If metals are treated only as trades, then profit-taking dominates. If they are treated as strategic assets, then positioning dominates. This is why the decision confronting investors at these levels cannot be outsourced to charts. Charts describe motion. They do not describe structure. Structure is revealed through behavior, through who is buying, through how they are buying, through what they do after they buy. Are they flipping contracts or removing supply? Are they seeking volatility or locking custody? Are they optimizing returns or reducing exposure? When behavior points consistently toward removal, custody, and insulation, it signals a different kind of market, one that is not preparing for a peak, but adapting to a shift. In such markets, selling strength can provide relief, but not resolution, because the underlying drivers remain. Resource competition does not fade because prices pull back. Monetary fragmentation does not reverse because volatility increases. Strategic accumulation does not unwind because sentiment cools. These forces operate on longer clocks, and longer clocks reward different decisions. This does not mean metals move in straight lines. They never have. Corrections occur, liquidity events strike, sentiment oscillates, but structure persists. The real risk, then, is not that prices fluctuate. It is that investors misclassify what they are witnessing, mistaking repricing for mania, mistaking insulation for speculation, mistaking transition for climax. This misclassification leads to one of the most costly errors in financial history: exiting structural assets because they behave unlike cyclical ones. At moments when financial architecture shifts, those who treat protection as performance often find themselves liquid but exposed. They have cash, but not leverage over outcomes. They have profits, but not positioning. The metals question at 100 silver and 5,000 gold is therefore not whether to buy or sell. It is whether to continue thinking in transactional terms or to begin thinking in structural ones. Transactions seek advantage. Structures seek survival. Advantage can be lost. Survival preserves optionality. And optionality is what matters most when environments change. Because once transitions become obvious, choices narrow, policies harden, markets adjust, access redefines itself, and what was once a financial decision becomes an administrative one. History suggests that by the time metals are universally accepted as strategic assets, they are no longer debated as investments. They are managed as reserves. At that stage, the question is no longer, is this the top? It becomes, who controls supply? That is not a trading question. It is a power question. And power questions do not respect entry points. They respect preparation. This is the real frame surrounding silver at 100 and gold at 5,000. Not celebration, not fear, but recognition. Recognition that risk itself is being redefined, and that in periods when risk is redefined, portfolios must be redefined with it, because when the system changes, the most dangerous position is the one that assumes it never will.